Right now, somewhere in the world, a fund manager is staring at a screen watching $600 billion vanish in 3 days, and they have no idea it's connected to the metal sitting in your jewelry box or your investment portfolio. By the end of this video, you will. My name is OG John AG, and you are watching OG John AG Official, the channel where we break down complex financial markets into clear, honest, educational content that actually makes sense. Today I need about 25 minutes of your full attention, because what I'm about to walk you through connects 3 separate financial stories that almost no one is reporting as one story. Before we go further, I want to ask you something. If you had to guess right now, before I tell you anything else, what do you think is causing silver to crash, gold to break a level Wall Street swore would hold, and the biggest IPO in history to lose more value than the GDP of most countries, all within the same single week? Hold that guess in your head, because I think it might surprise you how wrong it turns out to be. Here's what actually happened. Silver hit 6-month lows today. Gold crashed below $4,000 for the first time since November of 2025. SpaceX erased over $600 billion in market value in just 72 hours. And the Federal Reserve's rate hike probability jumped from 29% just 1 week ago to somewhere between 68 and 89% as of this morning. Most channels are going to report these as 4 unrelated headlines. They are not. They are one mechanism, working through 4 different assets at the same time. And by the time we get to the end of this video, you are going to understand that mechanism better than most people watching these markets right now. Let's start with silver, because silver is genuinely the headline today. As of Wednesday, June 24th, 2026, silver spot price is trading at $62.34 per ounce, down 4.23% in a single day. To understand how significant that is, you have to zoom out. On January 29th of this year, silver touched an all-time high of $121.67 per ounce. From that peak to today, silver has lost roughly 48% of its value in under 5 months. Nearly half its entire value, gone. The 52-week range stretches from $35.40 at the low all the way up to that $121 peak, which tells you just how violent this entire cycle has been in both directions. And here's something most people are missing in the panic. Silver is still up about 69% compared to exactly 1 year ago. So this is a brutal short-term correction, sitting inside a historically powerful longer-term trend. There's one number today that precious metals analysts watch closely, and it's the gold to silver ratio. Right now it sits at 66-1, a 2-week high. The 100-year historical average for that ratio is close to 40-1. Historically, when the ratio climbs above 60, some analysts have flagged silver as significantly undervalued relative to gold. We are sitting well past that threshold right now. Today's trading range alone, between $58.01 and $62.37, shows just how much uncertainty is running through this market in real time. So, why is silver falling this hard, today specifically? There are 4 reasons stacking on top of each other, and understanding each one is the only way to understand what could happen next. The first and most important reason is what happened to Federal Reserve rate hike expectations this week. Just 7 days ago, the market priced the probability of a December rate hike at around 29%. As of this morning, that number has jumped to somewhere between 68 and 89%, depending on which futures market you check. That is an extraordinary repricing in just 7 days. Since silver pays no interest or dividend, rising rate expectations make bonds and savings instruments relatively more attractive, and that pulls money away from metals. This is the foundation everything else in today's story sits on top of. But this is where the story becomes more interesting, because peace, of all things, is part of what's pushing silver down. The second reason is the US-Iran peace agreement signed recently in Switzerland. You'd think peace would be good for everything, including precious metals. The relationship is actually more complicated than that. The deal opened up traffic through the Strait of Hormuz, one of the world's most critical oil shipping routes, which pushed oil prices down roughly 2% today. Lower oil prices, lower inflation expectations, and when inflation expectations fall, the case for holding silver as an inflation hedge weakens. Reduced geopolitical tension also reduces safe haven demand. So a deal that's good for the world is, in the short term, quietly bad for the metals that fear had been propping up. The third reason is a kind of contagion coming out of the technology sector. When tech stocks fall hard, institutional investors holding both tech and precious metals ETFs often sell their metals to cover losses or rebalance. Today, the Nasdaq Composite fell 1.4% in morning trading, erasing roughly $680 billion in value, and that selling pressure bled directly into silver and gold as fund managers adjusted positions. The fourth reason is continued dollar strength, which makes silver more expensive for buyers overseas and reduces global demand. Dollar strength and silver strength have historically moved in opposite directions, and right now the dollar is benefiting from those same rising rate expectations. Now let's shift to gold, because gold broke a level today that deserves real attention. Gold's spot price has fallen to between $3,975 and $3,988 per ounce, down 3.07% on the day. Gold has now broken below the $4,000 level for the first time since November of 2025. When a major asset breaks a round number that's been treated as support, it can trigger additional automated selling, because risk management algorithms are often programmed to cut exposure exactly when levels like this fail. At 9 a.m. Eastern this morning, gold sat at $3,988, a $125 drop from the same time yesterday, and yet it's still $671 higher than it was a year ago, so the one-year trend remains positive even after this drop. Gold is down roughly 5% year-to-date in 2026, and sitting close to 20% below its all-time high of $5,595, reached on January 29, 2026. That's about $1,500 lost from the peak. The mechanism behind gold's weakness is straightforward once you see it. When real interest rates rise, meaning the rate on government bonds outpaces inflation, investors can earn a positive return from bonds without taking on price risk. Gold, which pays nothing, becomes relatively less attractive in that environment. Since gold's January peak, real yields have climbed meaningfully, and gold has responded by falling nearly 20%. That's textbook monetary policy transmission, playing out almost exactly the way the theory predicts. But here's the part most people are ignoring completely. Before you assume gold is simply broken, you need to see what the most sophisticated money in the world is actually doing with it right now. Central banks purchased a net 244 tons of gold in the first quarter of 2026 alone, and they did not pause that buying when gold fell from its January peak. They kept buying straight through the correction. Goldman Sachs currently maintains a price target of $5,400 for gold by the end of 2026. JP Morgan's target sits at $6,000 by the fourth quarter of this year, rising to $6,300 by the end of 2027. Morgan Stanley's target is $5,200. UBS forecasts $5,500. Every one of those targets sits well above where gold trades today. So sit with this question for a second. Why would the most sophisticated investors and central banks on the planet be buying aggressively into a falling market, while retail investors are selling into the same decline? That gap between what professionals are doing and what the headlines are saying is exactly the kind of thing this channel exists to unpack. Now here's the question nobody is asking, and it's the part of today's story that connects everything together. What does a rocket company have to do with silver? SpaceX shares are trading at $155.35 today, down 3%. But the staggering number is the 3-day picture. SpaceX hit its all-time high of $225.64 on June 16th, just 8 days ago. By June 23rd, shares had fallen to $147.11, an all-time low since the IPO. Over those 3 days, SpaceX lost roughly 23% of its value and erased over $600 billion in market capitalization. $600 billion is larger than the entire GDP of most countries on Earth, and it disappeared in 72 hours. The immediate trigger was SpaceX announcing it would issue investment-grade bonds for the first time in its corporate history, as part of what's expected to be a major borrowing program to fund its artificial intelligence ambitions. When a high-growth company that investors bought purely for unlimited equity upside suddenly starts taking on debt, it changes the entire risk profile of the investment, because debt creates obligations that can constrain future growth spending. Combined with broader tech weakness and the rising rate environment, that announcement created a genuine perfect storm. Shares briefly dipped below $150, the price of SpaceX's very first trade, meaning the entire post-IPO gain was, for a moment, completely wiped out before shares recovered slightly. I want to pause here for a second, because this is the point in the story where I'd ask you to do something small for me. If you're finding this kind of connect-the-dots breakdown useful, the only reason this channel can keep digging through data most outlets gloss over is the people who hit subscribe and stick around for it. I'm not asking because the algorithm needs it. I'm asking because the second half of this video is where the real payoff is, and I'd rather you not miss it. What happened next is where this gets genuinely interesting, because SpaceX's collapse connects to silver and gold in two completely different time frames, and they point in opposite directions. In the short term, SpaceX's decline is feeding into precious metals weakness through what's sometimes called a liquidity cascade. When a stock as large and widely held as SpaceX falls 23% in 3 days, institutional investors holding both SpaceX and precious metals face portfolio-level pressure. Their risk models flag overweight positions, and they're required to sell liquid assets to rebalance fast. Gold and silver are exactly that kind of liquid asset, which makes them frequent targets when institutions need cash quickly, even though gold is supposed to behave as a safe haven during stress. On top of that, SpaceX is expected to be fast-tracked into the Nasdaq 100 index within roughly 15 trading days of its IPO. When that inclusion happens, every passive fund tracking that index will be forced to buy SpaceX shares regardless of price, and to raise the cash, those funds have to sell something else first. That's not a fundamental view on gold or silver. It's pure mechanics, and it shows up in the data. Gold's correlation with the Nasdaq 100 has jumped from 24% over the past 12 months to 72% over just the last month alone, which is exactly why gold has been dragged down alongside tech lately instead of acting as the hedge people expect it to be. But here is where the story flips entirely, and this is the part I find genuinely compelling from a long-term perspective. SpaceX could end up becoming one of the most powerful long-term drivers of silver demand the metal has ever seen. SpaceX is pursuing orbital artificial intelligence compute satellites powered by space-based solar arrays, with early satellites reportedly capable of generating around 100 kilowatts of compute power, scaling across a much larger constellation positioned in dawn-dusk sun synchronous orbit for near-constant sunlight. The company also acquired xAI in an all-stock deal back in February of 2026, with the explicit goal of building space-based AI data centers to get around the power and cooling limits that ground-based facilities run into. Every one of those orbital data centers and every expanded piece of the Starlink constellation needs massive solar generation, and every solar panel needs silver. Silver has the highest electrical conductivity of any metal on Earth, and solar cells rely on silver paste to capture and move the electrical current sunlight generates. There is currently no commercially viable substitute for that role. Layer that demand on top of a silver market that's already in its sixth consecutive annual supply deficit, currently around 46.3 million ounces, and widening because mine supply is shrinking faster than industrial demand is growing. Some analysts have calculated that if current trends hold, above-ground silver inventories could be exhausted in roughly 3 years. That's a supply and demand story sitting almost entirely separate from this week's Fed-driven price action, and some of the largest, most sophisticated money in the world appears to already be positioning for it. Citadel, one of the largest hedge funds on Earth, opened a significant new position in SLV, the iShares Silver Trust, during the first quarter of 2026, right as silver prices were falling. When a fund with that level of sophistication builds a new position into a declining asset, it's worth asking what they're seeing that the short-term chart isn't showing you. And remember that gold to silver ratio sitting at 66-1 against a 100-year average of 40-1. Historically, when that ratio has stretched this far, silver has often outperformed gold significantly over the following 12 to 24 months, as the ratio reverts back toward its average. Nothing about that pattern is guaranteed to repeat, but it's the kind of historical setup that long-term investors take seriously. Now let's talk about tomorrow, because June 25th may be the most important day on the precious metals calendar for weeks. At exactly 8:30 a.m. Eastern tomorrow, the Bureau of Economic Analysis releases the Personal Consumption Expenditures Price Index for May 2026, the Federal Reserve's single most important inflation measurement, more closely watched by Fed officials than even the Consumer Price Index most people are familiar with. The market currently expects core PCE to land somewhere around 3.6 to 3.8% year over year. If it comes in above 3.8, it would likely validate the current hawkish stance and could push December rate hike odds above 90%, a scenario where some analysts believe silver could fall toward the $50 range and gold could test the $3,700 to $3,800 zone. If it comes in below 3.5%, that could suggest inflation is cooling faster than expected, potentially triggering a relief rally where silver pushes back towards $70 and gold reclaims $4,000 fairly quickly. And if the number lands right in the middle of expectations, markets may whipsaw in both directions, as traders try to figure out what an inline print actually means for future Fed decisions. None of these are predictions. They're simply the scenarios the market itself is currently pricing around. At the same moment tomorrow, we also get the final reading of first quarter GDP growth and the latest initial jobless claims figure. Stronger than expected GDP would reinforce the hawkish narrative, suggesting the economy can absorb higher rates. Lower than expected jobless claims would point to a tight labor market, which also supports keeping rates elevated or raising them further. Then, on June 26th at 10 a.m., the University of Michigan releases its Consumer Inflation Expectations Survey for June, which the Fed watches closely because expectations can become self-fulfilling. Rising expectations have historically leaned bearish for metals in the short term. Falling expectations have leaned supportive. So in roughly a 36-hour window, 4 separate pieces of economic data will land that could shape Fed policy for the rest of 2026 and into 2027. And given how sensitive this market currently is to every data point, swings of $20 to $30 in silver and $200 to $300 in gold within a single session are entirely plausible. So let's bring this all the way back to where we started. Silver's 48% drawdown from its January peak, gold's break below 4,000, and SpaceX's $600 billion collapse all trace back to the exact same root cause: a single week's repricing of Federal Reserve rate expectations, amplified by a peace deal that removed fear premium, a tech sell-off that pulled liquidity out of metals, and IPO mechanics that are forcing index-driven selling across unrelated assets. At the same time, sitting underneath all of that short-term noise, central banks are buying gold at one of the fastest paces on record. Every major bank's price target for gold sits meaningfully above where it trades today. Silver is running its 6th straight year of supply deficits, and a rocket company's AI ambitions could end up becoming one of the most significant new sources of silver demand this decade. Short-term mechanics and long-term fundamentals are currently pointing in almost opposite directions, and tomorrow morning's data is going to tell us, at least for the next few weeks, which one wins the argument. So here's what I want you to sit with after watching this. If the professionals and the central banks are positioning one way, while the headlines and the retail selling are going the other way, which side of that gap do you think usually ends up being right, and why? I'd genuinely like to know what you think, so drop it in the comments, whether you think this is a buying opportunity, a warning sign, or something in between. If this kind of breakdown helped connect a few dots for you, give the video a like so it reaches more people trying to make sense of this same week, and subscribe if you want to be here for whatever tomorrow's PCE number ends up doing to these markets. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership